Okay, so what I'd like to do is walk you through several of the chapter 2 end of textbook exercises to give you some applications on how to actually apply some of the material. So again, in the next upcoming slides, you'll see several illustrations on essentially how to work the textbook problems, which I'm hoping will help you with the homework and the quiz in the My Accounting Lab. Okay, in this particular exercise, this is very similar to the one on your PowerPoint illustration already, but I'm going to walk you through it again. It's the short exercise 2-4. This is at the end of the chapter in your e-text. And the goal of this problem is they want you to classify each of the following costs as either direct or indirect, and the cost object is the juniors department area at this particular Kohl's store. So one little department area with this in this store. So if this, assume this rectangle is Kohl's, and we are only interested in, let's say, this square corner of the actual store. So that's the idea. So assume, let's say this is our cost object. So number one, depreciation on the entire building, obviously, because that's not for one department, that is not easily traced. So you would pretty much say that's going to be an indirect cost, okay, to the cost object. So again, remember, direct is easily traced. Remember, I had mentioned that earlier. It's easily traced, and indirect is not easily traced. Part B, cost of costume jewelry of the mannequins in this particular department. Guys, that's going to be a direct cost. This is only for that department. That's easy to trace. Number 3, cost of bags used to package customer purchases at the main registers for the store. This is for everything. This is just isn't for the juniors department. So therefore, because it's not just exclusively for the juniors, you're going to say, I'm just going to use letter I. That's going to be indirect. The Medina Kohl's store manager salary, again, that's going to be indirect because this salary is not just for the juniors department, it's for the entire store. So you'd have to do some allocations to make his salary go directly to this particular department. That's not easily done, so you're going to say that's indirect. Cost of the security staff, again, this is for the whole store. It's the same reasoning for the department store salaries manager. That's indirect. The manager of just the juniors department, though, guys, that would be direct because this is all they do. It's pretty easy. Just take their salary. That goes right to the juniors department. The junior department sales clerks, again, same thing. That would be direct. And again, the reason that's direct is because they work only in that department. That's easy to trace their cost of that department. H, cost of juniors clothing. Again, I'm going to put a D for direct. This is clothing only for that department, so that's easily traced. That's direct. Cost of the hangers used to display clothing in the entire store. That's going to be indirect. To figure out exactly how many hangers are only in the juniors area, that might take some time, so that's not easy, so that would be indirect. Electricity for the entire building, that's going to be indirect. Remember, that's not just for the little area within the store, so it'd be, you have to do some allocations. That's not easy, that's indirect. Cost of the radio advertising, again, just for the store. Again, same reasoning, that's indirect. And then finally, junior clothing buyer salaries. Because they buy for all Kohl's stores, you're going to say indirect. If they only bought for this one store, for the juniors, you'd say direct. Okay, on the next two, I'm going to be looking at short exercise 2-6, and then we're going to look at 2-7. On 2-6, we're going to go through letters A through I, and I'm going to walk you through how to identify the concept of a product cost, inventoriable product cost versus a period cost. So this problem says classify each of Georgia Pacific's cost as either inventoriable product or period, and you need to know they make paper, lumber, and building materials. So that's their manufacturer of paper, lumber, and building materials. So letter A, cost of TV ads promoting environmental services. That's a selling cost, guys. That would be a period cost. So anything that's relating to general sales and admin, look at advertising, all that is non-manufacturing. That would be known as a period cost. Part B, purchase of lumber to cut into boards. Remember, this is what they do. This is part of their product. And because it's part of their product, this is going to be a product cost. That's basically inventory. Letter C, salaries of scientists studying ways to speed forest growth. Again, this is kind of more of R&D, that type of stuff. R&D would be considered a period cost, not inventory. Letter C is going to be period. Letter D, cost of new software to track inventory during production. That is going to be a product cost because it's part of production. Think of anything that's involved in the production of the goods is going to be attached to a product cost. So software would be product, and if we had to further break it down, we'd most likely say that's probably going to be overhead. Letter E, salaries of their top executive. That's a general admin type of expense. Remember I said earlier, think of your period cost as general admin. That's going to be a period cost. Letter F, cost of chemical applied to lumber to inhibit mold from developing. Well, guess what? That's part of your product. So letter F is also going to be a product cost. Letter G, life insurance of who? That's the CEO. Remember, that's an executive as well. That's general admin. So that would be a period cost. Letter H, cost of electricity at one of their paper mills. Well, that's a production facility. So that's going to be an overhead type of cost. So that's also going to be attached to a product cost. Finally, depreciation on the gypsum board plant. So this is again plant. This is a production facility. So again, that would be a product cost. Okay, so that's exercise S2-6. So now let's take a look at S2-7. We're going to further break these down. Again, they want, it's either going to be period or product. And if it's product, they want to know, is it going to be direct material, direct labor, or overhead? And if you recall, those are the three categories of your product cost. Okay, so again, these are all individual, independent types of items. This is letters A through H. Let's take a look. Standard packaging materials used to package individual units of products for sale. For example, cereal boxes in which the cereal is packaged. Well, guys, this is part of the product. You need that box before you can actually give it to a customer. So this would be a product cost. I'm just going to write over here product cost for letter A, and most likely would be a direct material. That's pretty easily traced to the product. Part B, lease payment on, notice it says administrative headquarters, and I mentioned earlier anything admin related is typically period, so you're going to say that is a period cost on Part B. Letter C, telephone bills related to customer service call centers. Well, that's going to be like a selling type of cost, and you want to think of your selling expenses as also period, okay, general admin, so letter C would be a period cost. Letter D, property insurance. As 40% of building is used for sales and admin, 60% is used for building. So guess what? You simply do an allocation. The 40% would be period, the 60% would be product. And this part, that's part of the product, the insurance, you'd say would be the manufacturing overhead. Letter E, wages and benefits paid to the assembly line workers. Well, they're actually making the product, so that would be a product cost. And most likely DL, we're going to say that's going to be direct labor. Letter F, depreciation on automated production equipment. Because it's production, anything in production, anything in the factory is considered product, so this is going to be a product cost. And anytime you have depreciation in a product situation, that environment, that's always going to be manufacturing overhead. So letter F is product cost, and that's actually overhead. Letter G, salaries paid to quality control inspectors in the plant. Well, guess what? Because it's in the plant, anything in the factory in the plant is product. So we're going to say that's a product cost, and we're also going to say that's overhead because that's going to be indirect. Not easily traced to the final product. Finally, repairs and maintenance on, notice it says factory. Again, anything in the plant or factory is a product cost. So letter H is also product, and this is going to be indirect type of stuff, repairs and maintenance. So you're also going to say manufacturing overhead. Okay, so in this particular exercise, we're going to be looking at exercise S2-9. And they want you to figure out the total manufacturing overhead. Remember, this is all those indirect material, indirect labor, indirect costs that are associated with the product. So this company, it says Frame Place makes picture frames. So suppose the company's May records include the items listed below. They want you just to figure out, it says the total manufacturing overhead in May. So this is going to be your total overhead cost. So we'll go through each of these. and then see if we can identify and talk about the rationale of why it's actually overhead. So first one, oil for manufacturing the equipment. So obviously oil, that's what, $35. That's definitely going to be overhead. You know, oil is not going to be consistently used all over, so that's not going to be something that's easily traced. So I'm going to put an MOH. That's going to be overhead. Wood for the frames, that's not overhead. That's going to be a direct material type of item, so we're not going to need that one. The company president's salary, well, that's a period cost, and so period cost is not product, so we don't need that one either. Then we've got interest expense. That's also going to be a period cost. If they don't specify interest, because you could have interest on inventory related items later on, if it just says interest expense, just always assume that's going to be period unless they tell you otherwise. It says the plant supervisor salary, guys. That's definitely overhead. Again, to trace their individual salary to every product is not something that's easily done. So that's part of overhead. So let me just circle these. So the 35 is one of them. The 4,500 is another overhead. The next one says depreciation expense on the company's cars used by who? Well, it's not used by production people, it's used by the sales force. So that's a general admin. So that would be a period cost. We don't need that. It says the plant janitor salaries, believe it or not, that is also part of overhead because they're in the plant and it's not easily traced to the product, which is your cost object. So that's indirect, that's overhead. Next one, plant, no, says plant depreciation expense. Again, that's also overhead. It's in the factory, it's in the plant. And I said earlier, anything depreciation will always be overhead if it's in the plant. Last one says glue for the picture frames. Same thing, glue typically could be not applied consistently. It's not easily traced. It's one of those little minor indirect items. So you're also going to say that's part of your overhead, that's part of your product. So in this case, it looks like we've got 1, 2, 3, 4, we got 5 of these. And if you were to combine and add these up, you would get a total cost of $15,935. All of these would be considered, it's a product cost, but this is that third category. This is how you calculate your manufacturing overhead. Okay, so for this illustration, I'm going to walk you through, first of all, S2-12, and then we're going to take a look at S2-13. So in S2-12, it says calculate the direct materials used. It says you are a new accounting intern at this Thomas Bikes. Your boss gives you the following information, and they want just to know the direct materials used. Remember, that's your first product cost. It says assume that the company's raw materials contain only direct. So they're making a big assumption there. You need to know that. So notice that what they give us. They give us import duties, beginning, ending raw materials, freight in, freight out, purchases of direct materials. So as I look at these, to me, the only one that's not going to be relevant is going to be this freight out, because freight out is considered a selling type of expense. That's a period expense, so we're not going to need that one. So I'm going to write out the formula over here. Your beginning raw materials looks like is $4,100. And to that, we're going to add purchases. Always look for purchases. They love to put that at the end just to make you look for it. So purchases of direct materials is $16,400. You're going to add that. So I'm going to put a plus out here. We're also going to add that freight in of $200. That's part of your cost. So your freight in is going to be added. So we got the $16,400. We got the freight in. Import duties is essentially kind of like a tax. So we got that. So we're going to add the duties that we have to pay. That's also part of that cost. And so if you combine all these to the $4,100, that's going to put you right about, looks like it's $22,000. That's what's available for sale. And then the ending balance, the ending raw materials is $1,900. You're going to subtract that. And we subtract that, you get $20,100. Guys, that's your number. That is basically your direct materials used. That's how you calculate it. So remember, I mean, it doesn't really matter what order you put this in, but you're going to add your beginning materials plus basically everything that you bought in, which is right there. That's going to give you total available. Subtract out ending, gives you direct materials used. Now, S2-13, let's do a cost of goods manufactured calculation. So on this one, it says Hansen Manufacturing found the following information in its accounting records. You've got direct materials used. Think of that's your first product cost. Direct labor, there's your second. And your overhead of $774,800. Work in process had a beginning balance of $79,500 and an ending balance of $86,500. So the starting point, I'll write this right over here, is going to be beginning WIP. Let me make it better, give myself a little bit more room. So we got beginning work in process, and the balance was 79,500. So to that, I'm just going to label the three product costs. We've got direct materials, and our direct materials is 515,500. We're going to add that. We're then going to add in the direct labor. Direct labor is 226,700. So think of that as another plus. And then finally, your manufacturing overhead, which is 774,800. So again, these are your three product costs. So when you add that to the 79.5, you get about 1,596,500. That's your total cost to account for. Okay, and then at that point, you're going to subtract out your ending WIP. Your ending work in process, they told you, was 86,500. So when you subtract that out, the difference is what you made. You're going to get $1,510,000. So that's your cost to get manufactured on S2-13. Okay, I want to walk you through at least part of a fixed versus variable example. And this is, again, part of S2-16. I think it actually goes down to letter O, but I couldn't get that all on one page. So I'll just kind of stop it at letter G. You have the answers to all of them. And I think after you listen to this, you'll kind of get the basic idea. So the idea here is to classify a cost as either fixed or variable. And remember, fixed is a cost that's constant. It does not change. A variable cost changes with activity. Okay, it's a very simple definition. So letter A, cost of coffee used at a Starbucks store. So that's got to be variable. The reason it's got to be variable is because the more they sell, the more they got to use. So letter A would be a variable cost. Letter B, hourly wages paid to sales clerks at Best Buy. Well, guess what? If they work more hours, you have to pay them more. So that's also variable. Letter C, monthly flower cost for a florist. Same rationale. That's kind of like their inventory. The more they sell, the more they got to pay. That's going to be your variable. That's also going to be considered a variable cost. Letter D, cost of fuel used for a national trucking company. Again, same thing. That's like a raw material. The more they travel, the more they got to buy. That's variable. Letter E, shipping cost. Again, these seem like they're all variable. We'll get to a fixed in a moment. Shipping cost, again, those change with activity. The more you buy from them, the more they got to pay for shipping. That's variable. Letter F, this is going to be our first fixed cost here. Again, rent within a certain time period, like a lease, is the same. That's also going to be considered fixed. Letter G, sales commissions is variable because the more you sell, the more you got to pay them. Okay, and just as I mentioned, other types of examples of fixed, even though these are variable, other examples of fixed types of costs could be, and you'll see these coming up later on, is things such as depreciation. You see things such as a salary, the word salary. If you see taxes, typically, insurance is another one that that's gonna come up a lot. Typically is going to be considered a fixed cost because those don't change. Those are a fixed payment. Okay, so for this particular exercise, this is going to be 2-21A. And again, it's more practice on classifying and identifying manufacturing cost. So in this particular problem, it says an airline manufacturer incurred the following costs last month, and these are in thousands of dollars. So we've got A through M. And of course, the first part is really just identifying, what type of product cost. Is it a direct material? Is it direct labor or overhead? And then also if it's a period cost. So I'm going to walk you through these, and then after that, we're going to talk about answering questions 2 through 6. So let's start with airplane seats. If you think about it, airplane seats going to an airplane, that's going to be a direct material type of cost. That's a product cost. Part B, production supervisor salaries. The fact that it says production, that's the key. Production, that's in the factory. That's going to be part of overhead. So whether you want to say it's not really indirect labor, it's going to be other types of overhead, but I'm just going to say that's basically MOH, that's manufacturing overhead. C, depreciation on forklifts. Again, depreciation, it's on the forklifts. Forklifts are in the factory which produce. So that's, again, manufacturing overhead. Letter D, machine lubricants. I'm going to assume this is machinery within the factory. And so again, that's going to be more manufacturing overhead. Letter E, it says factory janitor's wages. Again, the fact that they use the word factory means it's in the plant. That's all that indirect stuff. So again, that's manufacturing overhead. Letter F, assembly wages workers. That's most likely going to be a direct labor. That's again product costs. So again, A through F, these are all product costs, and I'm just identifying specifically where they would go. Now, even though this problem wanted you to break it down between indirect labor, indirect materials, and other overhead, it really doesn't matter because it's still overhead. Letter G, property tax on the corporate marketing office. Guys, that's a selling expense, so that would be a period cost. So remember we talked about this, general selling and admin is always period. Letter H, plant, which is the same as factory. Utilities, that's the production part of it, so that's going to be manufacturing overhead. Letter I, cost of warranty repairs. So that 225, that could be a tricky one, but typically that's for the selling aspect of it, of a product. So because that's most likely part of the selling, we're going to put that under a period cost. Letter J, machine operator's health insurance is the machine operator who's in the factory. So that's going to be manufacturing overhead. So that's where that 40 bucks is going to go. And let's see, we've got depreciation on admin offices. So again, this is selling. So that would be a period cost. And then we've got letter L, cost of designing new plant layout. So that basically, if you think about this, that $195, that's before production because you're designing it beforehand. So that's going to be expensed. So that would be a period cost. And then finally, the jet engines, the 1400, that's going to be a direct material. Now, I wanted to go back to one because I was looking at my notes as I was talking to you about this, but this letter J, where it says the machine operator's health insurance of $40, and sometimes you do get some gray areas in your decision making. If this machine operator, for example, is attached to actually producing something directly, then that could also be classified as direct labor. So really, some of these, it's like a what if, just in case. I initially said overhead because you're thinking health insurance, but if the health insurance is attached to a direct labor type of activity, it's also considered direct labor. Now, I say this because it depends on where the machine operator is. It depends on what they're doing. And I check my notes. In this one, they're actually classifying it as direct labor because they're basically saying this is part of a wage earner, wage labor. So, okay, so what? So just so you know, sometimes you do get some gray areas, but to go along with the solutions that you're going to be checking as you practice these, put this one in direct labor. But if you were thinking it might be overhead, you're not really going to be wrong there either. Sometimes, again, there is some gray areas. I think they should have specified this a little bit better than that one. Okay, now, so we've got number one, and then now we go to questions 2 through 6. Question 2 says, calculate total manufacturing overhead cost. So if you basically take each one of these that I had identified as overhead, don't use this one, and then just add these together, that's going to be your total overhead cost. Next one said calculate total inventory product cost. Well, that's basically everything here except the period cost. So basically, you would add them all up, and the only ones you don't want to include is the period because those aren't product cost. So because your direct material plus direct labor plus all your overhead is all of your product cost. So I'm just going to make a note, just add up direct materials plus direct labor plus your manufacturing overhead, and that's going to equal your total product cost. Okay, so you can do that, and then you can check your answers with the solutions in Blackboard. Your total prime cost, again, that's just going to be your total direct materials plus your direct labor. So just add those up. That'll be your total cost there. Total conversion is going to be direct labor plus your manufacturing overhead. So again, you'll just have to identify those like we just did and add those, and you'll get your total. And then finally, it says calculate your total period cost. Well, I already helped you identify these. You've got this marketing one here. You have the warranty repairs. You've got the depreciation on the admin and the design of the plant. So it looks like there's 4 of them. You add those up, and that would be your total period cost. Okay, so on this one, this is going to be exercises 2-24A, and then we'll also take a look at 2-25A. So in 2-24A, they want you to compute direct materials used and also the cost of goods manufactured. So let's break apart what's in the problem. So it says Ivanhoe Industries has calculated its cost of goods manufactured at year end. It says their accounting records show the following. So you've got raw materials inventory having a beginning balance of 17, ending balance of 15. It says during the year they had purchased 63,000 of direct materials. Direct labor for the year was 123. Manufacturing overhead amounted to 148. You've got some work in process information, beginning, ending balances, and then they want you to get the cost of goods made, cost of goods manufactured. Okay, so obviously in order to get that, I'm just going to off to the right here. Remember what we want. We want direct materials used. That's our first product cost. We'll want the direct labor. That's the second one. And then the third one, obviously, if they've got it, we'll want the manufacturing overhead, which they tend to give it to you. And remember, all these are going to get added into work in process. So before we can actually get to that, we need to get the direct materials used because they did not tell you that. So what you do is, I'm off this side here, I'm just going to write the calculation. Your beginning raw materials account was 17,000. And it said during the year they had purchased, here it is, purchased $63,000 of raw materials. So once you get that, you add that, you're going to get a total of $80,000 available to use. And then the ending balance of your raw materials, if I can find it, there it is, it looks like it is going to be 15,000. So there's your basic calculation. You're going to get $65,000. Write that right here. That's your direct materials used. And I'm going to label that as product cost number 1. So remember, this is your formula. Beginning raw materials, that's what you purchased. You get available once you add that, minus ending is what you used. The second product cost is simply your direct labor, and they gave that one to you directly. That's 123, so I'm just going to put this one right below it. So we're going to add these two together. And then we're also going to add in the manufacturing overhead, which they gave it to you, which is $148,000. So remember, you've got your 3 product costs right here, and all of these are going to be added into your beginning work in process account. And they told you that had a balance of $26,000. That was the beginning balance. So we're going to add these 4 together, and that's going to give us a total of $362,000. That's basically your total cost to account for right there. So this 362 is your total cost. And then the last step is to subtract out your ending work in process, which was, it looks like it's $19,000. And when you subtract that out, you get $343,000. That's your COGM. That's how much they made. That's basically what's going to be moving from work in process into finished goods. So I'm just going to draw a T account illustration down here just one more time. The basic idea here is we're looking at everything in work in process that we were working on. This calculation right here takes you through step by step how you figure out what you finished. The 343,000, I don't know why I wrote over here that I should have wrote finished goods, I'm sorry. That 343,000 is going to be transferred over into the next department, which is your finished goods. So that basically should answer everything for 2-24A. Now, let's take a look at 2-25A. So in this one, it says compute the cost of goods manufactured and cost of goods sold for Blue Sea Company for the most recent year using the amounts described next. So assume that the raw material inventory contains only direct material. So again, so here we go. They've given us a problem. They give you all the data. Notice we've got our inventories here, raw materials, work in process, finished goods. We've got some purchases of direct materials. There's direct labor, indirect labor, insurance on plant, depreciation on plant, repair and maintenance on plant, marketing, and so forth. So I'll just kind of tell you right away, these last 2 right here, we're not going to need those for cost of goods manufactured or cost of goods sold, because those 2 are period costs. Remember, marketing is selling, and your general admin expense, those are also your period costs. So first step is we got to figure out, again, direct materials used. So we'll start with our beginning raw materials, which looks like it's 27,000. So we got this one. It looks like they purchased 79,000. So we're going to add that to the beginning inventory, and that's going to give us $106,000. That's basically raw materials available. Your ending balance looks like it was 31,000. So we're going to subtract out that 31,000. And once you do that, you get 75,000. And that's going to be your product cost number one. That's your direct materials used. I'm going to put a number one next to that. Number two is going to be our direct labor, which they give it to you right there. That's 83,000. So we're going to add that to direct materials used. And then the third one is going to be our manufacturing overhead. Now, the trick in this one is they didn't tell you actual overhead. You have to identify it. So I'm going to go through these costs again to help you identify it. So let's go down here. We've already covered these first group here. Let's start with indirect labor. That's going to be manufacturing overhead. That's indirect. The next one I see is insurance on the plant. That's manufacturing overhead because a plant means factory, so that's overhead. Depreciation on the plant building. There you go. It says plant, so that's factory. That's manufacturing overhead. We've got repair and maintenance on the plant. That's again manufacturing overhead. And then I already told you that the marketing and the general admin are period costs. So in this problem, it looks like we've got 1, 2, 3, 4 overhead accounts. If you were to combine these and add them up, that's going to give you a total overhead of just about $70,800. So you actually have to calculate this one, and I just identify them. You just have to add them together. Okay. So once we've got that, we're going to add these to our beginning work in process. Our beginning work in process is $43,000. So these are our big three product costs right there. We're going to add those to beginning work in process. That gives us $271,800. That's our total cost to account for. And then we're going to subtract out our ending work in process, which is $28,000. So once we subtract out that $28,000, I believe it's 28, that should give us our cost of goods manufactured, which is $243,800. So I'm just going to write COGM. That's going to be our cost of goods manufactured. Now, before we can get the cost of goods sold, we need to figure out how much did we sell. So up in this corner, right-hand corner, I'm going to write beginning finished goods because this is the next step. Beginning finished goods was 16,000. We're going to add the COGM. This is the new finished goods we just finished. That's $243,800. And then once we add that, that gives us $259,800. That's our available inventory to sell. And then finally, our ending finished goods is given at, looks like it's 29,000. So you simply subtract out the 29,000. And when you do that, you get 230,800. That's your COGS. That is how you get your cost of goods sold. So this is a good problem. It's a good practice problem that takes you through all the different cost flow steps from raw materials, what you used, to direct labor overhead. This gets your product cost. You figure out what you finished. You transfer that to finished goods. You figured out what was left to get to cost of goods sold. So you should always know, even though we're only adding and subtracting, you need to know the relationships and the definitions. Okay, so for this illustration, this is problem 2-49B, and it actually has two parts to it. I'm actually going to show the next part on the next slide. So on this particular slide, we're just going to be dealing with part 1. And on part 1, the requirements is they want us to prepare an income statement, which this is for Robin's Roses. We're going to account for this as if they are a merchandiser, and it's for the year ended 2013. So using this data, they give us sales revenue, utilities, some merchandise inventory balances, rent, sales commissions, and then purchases of merchandise. So before we can actually get to the income statement, we need to get cost of goods sold. So for a merchandiser, basically, here's the calculation. You're going to have your beginning inventory balance, which in this case, it looks like it's going to be $12,000. So I'm going to write that there. We're going to add in the purchases, which in this problem was $34,000. So they bought $34,000 of merchandise. If we add that, oh, and let's see, do we have anything else? Looking for just any sort of other odd items. I do not see that. So in this case, this purchases would represent everything, including any sort of shipment costs and so forth. They just lump that into one amount. So at this point, we are at $46,000, and that would be how much merchandise is available for sale. Then we would subtract out the ending inventory balance. So at December 31st, that would have been $9,900. So I'm going to put brackets around that to indicate we're going to subtract that. And after you subtract that, you're going to get $36,100. That's going to be your cost of goods sold. So now that we've got that, we can now put together your basic multi-step type of income statement, starting with our sales revenue. So our sales revenue would be $59,000. So I'm going to write that there. We're going to then deduct our cost of goods sold, which we just determined was $36,100. And of course, you remember that the calculation, sales minus cost of goods sold equals your gross profit, which basically means this is what you're making just on inventory. So in this case, it's going to be $22,900. Now, so basically you have your cost of goods sold, which essentially is kind of like a product cost type of expense. And then everything else below that is going to be your operating expenses. And so if we go back up, you've got utilities of $1,200. So we're going to deduct that. We have the rent, which is $3,600. We're going to deduct that. And we also have some sales commissions of $4,600. We will also subtract that. And once we do that, we're going to get a net income or operating income of $13,500. I'll just write NI for net income. And that's basically part one. Now, you can also go back and look at the actual textbook solution presentation in Blackboard. It makes it look a little bit nicer than this. But again, I wanted to walk you through the steps, step by step, looking at how do you get the calculations. And this problem, I would suggest getting cost of goods sold first. Cost of goods sold goes there on your income statement, and then you can do the rest. Okay, now on part two, we're going to look at it from a manufacturing perspective. And then they're going to give us a bunch of costs down here, and they also want us to do an income statement for that one. And it's going to be basically the same type of idea. We're going to figure out what is cost of goods sold, but before we can do that, we have to again look at what's the product versus the period cost. We also have to look at cost of goods manufactured and that cost flow before we can actually do it. So there's several more steps on this one, and I'll show you how to get to that answer on the next slide. Okay, so for this one, the first thing we're going to want to do is we're going to want to get our direct materials used, and then we'll look for direct labor, and then we'll get the overhead. Now, they give you all of the cost here, product and period, and we'll go back and discuss the period cost and that kind of stuff as we do this step by step. So the first thing I'm going to do, in part one, they want you to get the cost of goods manufactured. In part two, it's going to be the income statement. And then, of course, part three talks about the format of the income statement. I think once you kind of compare them, that'll, all the differences and the similarities will fall out. So our focus will be on these first two steps. So to get cost of goods manufactured, the first thing we're going to do is try to figure out the direct materials used. So the first thing is we'll look for a beginning raw materials balance, and they give that to you. It's going to be $14,000. So I'm going to write that right up here at the top. So we can kind of maybe even put a check mark to know that we took care of that. And then the next thing I'm going to be looking for is did they buy any materials? I spot it right here. It says direct material purchases. That's $35,000. We're going to add that to our beginning inventory. So if I add that, that's going to give us what, $49,000 of raw materials that's available to use. And then we're going to subtract out the ending raw materials, which in this case, it looks like the ending raw materials balance is $10,500. So I'm going to put brackets around that. So we're going to subtract that. And once we have done that, then that's going to be able to give us our direct materials used. So in this case, that'll be looks like it's $38,500. So I'm going to write direct materials used, and I'm going to put a 1 next to that because essentially that is our first product cost. The second one I'm going to look for is direct labor. Guys, that's right there. That's $21,000. So I'm going to write that right here. And that's our product cost number 2. Again, we're going to add these two together. And then the third one is going to be our manufacturing overhead. Now, it's the same thing as some of the previous ones. They don't just say manufacturing overhead. You're going to have to go through here and identify these. So I'm going to do that right now. So let's start up at the top. Utilities for the plant. That's going to be manufacturing overhead because that's in the factory. Delivery expense, that's a selling expense. So remember, that's going to be a period cost, so we don't need that just yet. Sales, salaries, expense, again, that's a selling cost. So that'll be a period cost. Again, we don't need that yet. Plant, janitorial services, you see the word plant, that's the same as factory. That's going to be overhead, so we're going to need that one. That's MOH. We've got the work in process. We're going to come to that later. Finished goods, we'll need that later. So all the inventories we will use, just not yet. There's our sales revenue. We've got customer service hotline expense. Again, that's another selling cost. That'll be period. And then let's see, we've got rent. Here we go. On the manufacturing plant, that's also going to be your manufacturing overhead. So in this case, you would have to add the utilities, the plant services, janitorial services, and the rent. It looks like those three would represent your manufacturing overhead. And in this case, if you were to add those together, you're going to get $14,050. So I'm going to put that right here. So $14,050, that's your third product cost. We're going to combine all these. We're going to add these to the beginning work in process. And the beginning work in process, it looks like, is actually 0 in this case. So they started with 0 in beginning work in process. And so I believe, let me just make sure I looked at the right one. Yeah, it's right here, 0. So our beginning work in process is in fact 0. So if we were to add these three together, our total cost to account for looks like it's $73,550. So that's our total cost. Then we will subtract out the ending WIP, ending work in process. We're going to subtract that, and it looks like that's going to be $3,500. So that's how much was left in process at the end of the year. So when we subtract out that, we get, it looks like in this case, $70,050. And I'm going to call that COGM. That's going to be the answer basically to number 1. That's your cost of goods manufactured, $70,050. Now, before we get to the income statement, let's figure out our cost of goods sold. So we need beginning finished goods. So our beginning finished goods, again, in this case, it looks like it is 0. We're going to add the cost of goods manufactured to that which we just got was $70,050. That gives you $70,050 available. And then we're going to subtract out the ending finished goods. And the ending finished goods, it looks like, is going to be $6,500. That's how much you had basically was left in inventory at the end of the year. So $63,550, here's that bottom number, $63,550 is your cost of goods sold. So over here, let's put up the income statement. We've got our sales revenue of, it looks like it's $102,000. We've got our cost of goods sold, which we just calculated to be $63,550. We subtract that out, we get our gross profit, which in this case is $38,450. And then below that, we're going to subtract out all of our operating expenses. And in this case, we're looking for our period cost. So we've got the delivery, just identified those already. That's the $2,000 there. We also had the sales salaries. So I'm just going to put salary right there. That was, looks like it was $4,700. And then let's see, we also had the hotline expense. So I'm just going to put hotline, and that was for $1,100 right there. And that's basically all of your period cost. You're going to subtract that. You're going to get an income, in this case, of $30,650. Okay, so just remember, this cost of goods sold, remember that's your product cost expense, that's your inventory expense, and then these three right here, and everything else is basically your period cost. Now, again, you can refer to the solution manual. It has all this typed up in a nice little presentation format, and hopefully you can follow these steps and understand how to get to the final answer.